So the purpose of today's call is just to give our listeners a bit of an idea of where we stand in terms of outlook, market commentary, and a little bit of added color on our Market Watch weeklies. For those of you that are new to publication, it provides a pretty good overview of what we see in terms of trends and actual events in the market. If you're ever wondering what we're thinking, this is definitely a great resource to sort of access. Gives you a quick update on our collective mindsets with regards to some of the recent commentary, and we'll get into it on a bit of a Q&A. There's a massive tug of war right now between investors and speculators out there, and it's these speculators that have kind of been driving the volatility in the markets of late, unfortunately to the downside. But it's when we've been kind of telling clients to be investors through this that we think it pays off, obviously in the long term. So we've also had some questions come in, and Erik, let's kick it off with you. Canaccord's chief market strategist, Tony Dwyer, has obviously been a very vocal bull of late, and especially in recent years. Now, the current situation is obviously quite fluid, but what has he been saying these days?
Just to reiterate, Shawn, all of our analysts' reports that are coming out, I don't think that they can write as fast as the information is being coming out in the marketplace, but we do have that all available for you. So guys like Tony Dwyer, Martin Roberge, and certainly our technical analyst, Javed, have those, and we have that all on file, and happy to get that out to you. With respect to Tony's slant right now in the market, long-term overview, although his target for 2020 has been lowered, is still bullish. Tony, in his most recent article or his most recent commentary, you know, he's talking about a tug of war, obviously, between this huge influx of monetary policy that we've seen from not just the U.S. but from governments around the world, tugging on the other side with the COVID-19 news that's coming out daily, not just locally and provincially here in BC, but around the world. This morning there was talk about perhaps Spain and Italy starting to open things up, which is, as you can see in the markets today, has created a bit of an upswing on the day. I would say that, you know, although Tony is still bullish, he is cautiously optimistic that we've seen that whoosh that he talked about, and since then we've seen the reflex rally that he's been chatting about in his notes, and he has been, although with the recent $2.3 trillion spend and add to liquidity in the States, he's still nervous that the markets at best will just be consolidating here. So for those of you that feel that maybe you've, my kids call it FOMO, but for fear of missing out, for those that are nervous that maybe they've missed out on this recent rally, Tony's comments at least has been that we'll probably have another chance, and at best case we'll see some consolidation here in the near term, but reiterating again that his long-term outlook is positive, and most of our clients, if not all, are investing for what the market's going to do in three months, 6 months, 2 years out. So still bullish, and you know, again, we have his commentary available. So whoever sent that question in, maybe they're not getting it. So happy to provide that. Just send us an email and we'll get it to you.
And some of the other recent very good commentary that Canaccord has access to is a great technical analyst that it's great to get two sides of every coin. And he puts, you know, the technical input into the fundamentals that we use with Dwyer, as you mentioned. What has our technical analyst been seeing in the markets of late?
Yeah, good question. Javed has been for those that have been avid readers of Javid, he's been talking about this 4-year bull run that we're in, and prior to obviously COVID and the Black Swan event that happened in late February, which we've all seen and felt the pain of this market sell-off. Still believes that we're in this cycle. He obviously looks at a number of technical indicators. There was a good piece that he put out yesterday that indicate that, you know, the balance of power is shifting from sellers to buyers, and is still supporting his base case that the major price low that we saw, I believe it was March 23rd, was the low and is in place for equity markets. He has noted recently with the run that we've seen to the upside in the markets that he does expect the markets to find a bit of a lower low from these highs that we saw last week. But all of his indicators point that markets are actually in quite good shape. He cited, I think one of the big things he cited yesterday, Shawn, was the volume that we see on the upside as opposed to the volume that we see on the downside, being that we see a lot more buyers in the market when the market's moving higher, and we're seeing less sellers when the markets are going lower. So bullish indicators all around in that report. So Javid, I should probably say that Javid has been, out of all of our analysts, probably the most bullish, and he doesn't look at fundamentals. So he is a technical analyst looking at volumes and sort of the bigger picture. So he's been positive. So, you know, good for equity holders.
Yeah, I would actually add to that. I think one of the two big Black Swan events that he was looking to take off the table that would remain or keep intact his bullish thesis was actually this OPEC deal, which of course was agreed to over the weekend. So that was one of the big negatives that he needed to see come out of the market in order to maintain the bullish thesis. So that was a big positive catalyst for that. Mark, let's bring you into this. Another question here. Obviously, the markets have been up on a stick here the last 3 weeks. It's been an impressive rally from the bottom. A lot of people are starting to wonder whether this curve flattening of COVID is priced in. What are you thinking about that one?
Yeah, COVID, you know, it's hard for anyone to really know exactly where this is going or where it might crop up again. But from everything that we read, and looking at the overall chart, you know, we saw a good one this morning. It shows that we're past the acceleration phase for pretty much every major economy, every major country in the world. And I think in large part, at least from this initial move, we have seen that relatively priced in. So, you know, I suspect that this last week and a half has really been pricing that in. You know, yesterday obviously was a bit of a down day. Today's back up right now, but I would suspect right now, with that being primarily priced in the quick move, you know, like our portfolio strategist Martin Robert says, we're moving more from you know, a market of stocks to a market of the market to a market of stocks, like from a stock market to a market of individual stocks, where we need to be more selective and more picky on what we invest in. The market moves pretty quick to bounce back, and now we're seeing where are the opportunities in this market. And certainly we've got three main strategists that we follow. Erik has already highlighted Javid, who does our technical analysis. That really gives us some stocks to look at the forefront. And then we can take into account Martin Roberge on our fundamental side and our quant base, and then Tony Dwyer on the US side, and really narrow down where we're looking in the portfolios. So we do believe it's on the COVID that we have started to move into the past the acceleration. But you know, now it's just a matter of waiting to see if that drops off. So I think we'll unfortunately, the numbers economically are yet to come out, and they are going to start coming out relatively soon. But I think we've seen the initial bounce, and now we're going to go somewhat sideways for a while. And our opportunity is to find the right stocks that come out of this the fastest.
You talked about the portfolio there a little bit, and it's obviously a market of stocks as opposed to a stock market. Maybe where specifically are we starting to see value here?
Well, overall value, I mean, is going to be anything that can come out of this opportunity on a positive. So, we're certainly, as you mentioned on the oil side, there's a lot of value there, but we're not really willing to dip our feet in that too much here. That's still a ways off, and seeing the demand pick up is going to be later quarters. So there may be some opportunity there. We're not quite anxious to do that. On the technology stocks, there's obviously a lot of those companies are continuing to do well throughout this environment. And we're not going to be trying to pick up off the bottom feeders. We want to find the ones that are going to continue to do well. So, whether you look at the Amazons or the Shopifys who provide all the back office for a lot of these online companies, some of these companies that have been hit, some of the airlines, some of those sorts of companies, I don't think we're there yet. Certainly we're seeing a lot of support from government, which is great. They will be bailing out a lot of these companies, but I'd say on the financials, a lot of Canadians own a substantial portion of their portfolios in financials. They're coming through this in a much, much better financial weighting or financial wherewithal than they were in 2008. They're back, their financials look very strong. So, I think there's a lot of opportunity there. Erik, you got any other sectors that you think maybe I should add to that?
Yeah, no, listen, I would agree. And I think to steal something else that Roberge was talking about, the speed and the rapid response that we've seen from not just the U.S. government and the Canadian government, but governments around the world, is providing sort of a more solid footing as this tug of war continues with the COVID numbers and flattening of the curve, and the government backstop on debt that exists around the world. So certainly, some of the names in our portfolio that we currently own, the Apples, the Microsofts, the Amazons on the technology side, and I'd be remiss not to include the financials, because the financials should be one of the first sectors to rebound from what's happened here. There may be a question later, somebody may be mentioning gold later and maybe some of the base metals, but I would say that all this money that's being pumped into the system from the governments around the world is definitely going to be inflationary, and inflation has been a pretty good traditional hedge for gold. So keeping an eye on gold, and we do have a gold name in our portfolio that's performed extremely well recently because of the uncertainty that's existed. So I don't really want to get into specific names, because I think that although positioning is certainly key here, I think, and we don't want to come across as market timers. We want to own the best companies that we can in an environment as this world sort of heals itself from COVID-19, which seems to be looking better and better. As I mentioned earlier, it looks like Italy and Spain certainly peaked out on that curve and looking to open up their markets again. So fingers crossed. It's something that none of us have seen, and nobody listening has seen in their lifetime. So
maybe, Mark, a bit of a follow-up question to what you were saying there before, but we got a question here that's addressing obviously these massive levels of unemployment. What sort of comparisons are we seeing out there to, 1920s era to what there is today. And obviously, you know, we talked about it before, but central banks and governments have acted dramatically and very swiftly to sort of offset and support the unemployed throughout this. But what are you seeing out there where this comparison to maybe, you know, the 20s and 30s and even 2008, 2009 isn't the greatest sort of market to compare them to?
I would, on this topic, we have an excellent piece by our quant strategist, Martin Roberge, that does go through all the top points of why he believes the 1929 to 33 period was very different than the period we're in right now. But, you know, I could highlight a few of, you know, sort of the key points that I think. You know, obviously unemployment, we're into the double digits. We're probably getting into the 20+% in the fairly near term, but it's a bit uncertain on how long that is going to stay up at those levels. You know, the world is going to continue and come through this, and this is a fairly short spike. So it's a little hard to use that unemployment numbers right now. It's still too early. The biggest difference really is that the Fed has no hesitation to use their substantial liquidity and provide liquidity into the system. They didn't provide that at the same level. Well, they didn't provide it at all in 1929 to 1933. In fact, the money supply dropped by a third, versus now it's getting substantially increased. That also, I mean, they've also made sure that they're going to keeping interest rates low. So they've been doing that through purchasing AAA corporate bonds, propping up the bond prices, bidding down interest rates. So that's going to provide substantial liquidity too. You know, in 1929 to 1933, we saw lending dry up completely. You know, by providing these continued low rates and providing liquidity into the system, lending is not drying up. So we're not seeing corporations or consumers. You know, in fact, we're still seeing a housing market. You know, it's not nearly what it was before, but it's certainly far different than the 1929 to 33 period. So by seeing that lending continue, by seeing the money supply really being cranked up, and I actually was on a call with PIMCO this morning, Ben Bernanke, who's one of our previous Fed chairs, was speaking, and you know, he was suggesting that the Fed has no problems continuing to provide the liquidity and the money supply into this system. You know, the benefit that the U.S. has is that they are still the currency of choice and the reserve currency. So they have almost unlimited, let's not say unlimited, but they have substantial capacity, and they're far from being there yet. So I'd say the bottom line is that all this all the monetary and fiscal reflation is going to be, and the substantially better financials from our banking system compared to relatively, you know, 2008 is not going to allow this recession to turn into a depression type scenario.
Yeah, and I just add to that too, that that's one of Dwyer's major bull theses is that so as long as there's access to credit, notwithstanding COVID, people are able to spend money, and that's a positive for the market.
Yeah. We touched on it briefly a little bit earlier, but we got a client here that wants to know the outlook on energy. As I mentioned, we had that coordinated cut out of OPEC, 9.7 million barrels over the next 2 months, starting May. Oil is obviously down since that announcement. What are the thoughts on whether that was enough or if more is necessary in terms of coordinated output cut?
Sorry, go ahead, Mark.
I think more is I think more is going to be necessary. Demand is not picking up anytime soon. You know, if we would look a couple years out from now, I am quite confident that we'll see oil back, you know, at least halfway back, or if not all the way back to that $50 range. But it's going to take a long time to get back there, to get that supply trimmed back, to get that demand cranked up. So in the near term, you know, I certainly would be very hesitant to be looking at any oil companies that had, you know, especially on the Canadian side. Unfortunately, we're going to be we're going to be topping up all of our reserves pretty fast here, and the spread between WCS and WTI is, I would suggest, is going to be growing, not decreasing. So there's not a lot of money to be made on the oil and gas front for the near term. Erik, what you had something to add there?
Yeah, I would just add to that. Yeah, I just add to that everything I've been seeing as well, the 9.7 million barrels a day cut isn't enough, and that's certainly the supply side. And I know that the Saudis have come out today saying that they're happy to cut further as long as it's a joint effort by all the other countries around the world. The demand, so the reason that I believe oil is challenged here is not so much on the supply side, which is great to get that news that we did over the weekend. It's the demand side, and until we get a better idea as to when everything is going to get back to normal, which it will, and this will pass, the demand of oil is sort of a bit of an unknown. It's too early to know where that's at. So agree with Mark that probably too early to be looking at
I'd add into that on the oil side, and I think what this situation has really pushed to the forefront a little bit more is the environmental, social, and governance issues, and looking at, on the environmental side, that there's a lot more options out there now. People are starting to think, well, maybe we don't need to just have everything running by oil more and more. So I think we're going to see a decrease in future demand stemming from this a little bit as well. That being said, obviously oil is in everything that we use on a daily basis. That's not going to go away. The consumer is going to spend, and we're going to need more product. But we'll probably have some benefits coming from this in other power alternatives. Obviously, on the materials side, we're going to see higher demand for materials that produce electric cars, that sort of thing. So there's a bit of a shift, and this may speed that up a little bit more.
Yeah.
Blue skies over China.
Yeah, exactly.
I think just maybe to quantify that demand side that Erik, you were touching on. Well, obviously this is very fluid and no one knows exactly what's going on week to week. The demand destruction from everyone just being stuck at home is roughly 30 million barrels a day, they figure right now. So if you look at 9.7 million barrels being cut off from supply, clearly there's still a big disconnect between the two. Thought that was interesting just to kind of quantify it. But last question here, and maybe Erik, I'll throw it your way. We've seen a pretty strong rally here in the US dollar amidst all this uncertainty. It got up as high as, I think, 146 on the Canadian loonie. It's down about 8% from that level in a couple of weeks. Where do you think this takes the Canadian loonie in comparison to its historical trading range of 130 sort of thing?
The loonie is an interesting one, and it always causes debate in the office. So I think Mark will probably want to touch on this too. But the U.S. dollar has been a flight to safety. So I think the recent up in the U.S. when you have massive panic around the world, we had. Obviously, March 23rd would have been the day of the most panic. People buy U.S. Treasuries, and when you buy U.S. Treasuries, and I think, Shawn, you might remember, I think the yield was negative on the 23rd, but it's the safest place to go. And notwithstanding all the other reasons that the loonie might down, I'm not going to get politically touched on oil. U.S. currency is the new place people go rather than going to gold. And quite frankly, I don't see the although it did spike there at massive panic, I don't see it getting a lot weaker from where it is here. So I don't know if that answers your question, Shawn.
Yeah.
But
it's
a flight to safety. So when
Uh-oh.
I was
Sorry?
cutting out.
I think Erik just cut out.
Yeah, I think we did there.
Oh, there we go. There
Shawn,
he
what
is.
were you going to say?
Oh, I would just say with the massive amount of fiscal spending, U.S. dollar kind of has nowhere to go but down amidst all this. And you're probably going to want to see other governments as well drop the value of the U.S. dollar, because strong U.S. dollar is a negative, obviously, for U.S. growth. So I think there's just a consensus among governments out there to want to see maybe a weaker U.S. dollar on that as well.
I agree.
Yeah. Cool.
I agree.
Mark,
For
do you have anything on
Erik
that?
and I are actually awfully close in agreement on this for a
That's
change.
the first for the currency.
That's a first. Right on.
It is. I agree. You know, I think the flight to safety is going to hold the dollar up for a while, but at the end of the day, like Shawn said, they need to see it lower. The U.S. wants to see it lower. Certainly, when you're taking on this much debt, you definitely want to see your dollar lower. So the drive will be to get it lower, but that I don't think will happen in the very near future. I think we're probably going to be in a trading range somewhere in the high 130s, low 140s for a while. That would be my guess.
Yeah. Any closing commentary, Mark, Erik?
Markets have been fluid. Information has been rapid. As I mentioned earlier, I think all of our analysts have sore hands from writing as fast as they can to keep up with the influx of information that's been coming out. We do have all that information that we're happy and readily able to send out to our readers and listeners on our first call today. This too shall pass. We'll see, and as things unfold, we're there with everybody, and certainly if anybody has any questions offline, please let us know. Mark?
I agree with Erik. We have a lot of information. Obviously, our job is more reading and disseminating information as much as possible and understanding it, what it means. Shawn, Erik, and myself are very active on the portfolio right now, as you may have seen from some of our trade notes, taking advantage of making sure we don't have anything in the portfolios that is going to be an issue from a financial standpoint, but it's also going to benefit coming through this. So happy to share that all the time, and I think we are with most of you already. But please feel free. I think everyone has our cell phone numbers now for the first time ever. So you feel free to call. We're always available. We may not be able to pick up right away, but don't hesitate to call, reach out, email, whatever, text, and we'll walk you through what we're doing and how we're going to get through this in a better position than we were coming in.
Perfect. And I would just kind of add to close off that this sort of conversation is what we really try to highlight in each of the weekly market commentaries. So again, just to reiterate, if you're ever wondering what we're doing or what we're seeing, this sort of conversation that we just had is basically depicted in each weekly market comment. So if you're not using that already, it's a great tool to sort of read and add that to your weekly list of reading material. It comes out every Friday. So again, just make sure to have a look at that each week.